Very warm welcome to everybody present in our annual call. Along with me, I have Mr. Qtr4, our CFO, and SGA team, our Investor Relations Advisors. I hope you have all received our investor presentation, and those who have not received it, you can look at the stock exchange or our website. Financial year 17-18 was a very good year for the company with consistent growth on a quarterly basis. We have seen favorable market conditions with an improvement in demand in our product. This was possible due to demand scenario, customer-centric product development, and in-house process development with cost advantages and sustainability. As you are aware, the Board of Directors along with management has approved various CAPEX projects in financial year 2017-18. The first CAPEX, which was phase 1, was announced in March 17 for rupees 170 crores, and it had two parts. The first part of expansion at Navi Mumbai site is expected to complete by first quarter of this year. Expansion at Dahej, which is expected to complete by the third quarter of this financial year. Phase 2, which was announced in December 17 for rupees 168 crores. This expansion is planned for production of rubber chemicals and intermediates at Dahej and Navi Mumbai. The CAPEX is expected to be completed during the first quarter of next financial year, that is 19-20. Phase 3, which was announced in January 18 for rupees 87 crores, the project is in progress and it is expected to be completed in the first half of next financial year, that is 19-20. All the three phases summed up together, the total CAPEX planning for the company is rupees 425 crores, and significant portion of this will be funded through internal accruals. This expansion is likely to give us asset turnover of 2x. The expansion is aiming at both domestic and global markets. Over and above the announcement of the CAPEX, our R&D continues to work for the future of the company, particularly towards developing new products as well as new processes in the existing businesses with a very focused attention on cost improvement and environmental issues. Our research center is recognized by Ministry of Science and Technology, Government of India. During the financial year 17-18, I am happy to inform you that the company has received a Responsible Care Award from Indian Chemical Council for 3 years. Responsible Care is a global chemical industry unique initiative to improve health, environmental performance, and enhance security to communicate with stakeholders about products and processes. We are among the few Indian companies who have received this award in 2017 and 18. Before going to the updates of the industry and financials, we are happy to inform you that the Board of Directors has recommended a dividend of rupees 2.5 per equity share of rupees 10 for the financial year 2017-18. Now, I would like to hand over to Mr. Qtr4, who will give you updates on industry and financials. Thank you very much.
Thank you, Mr. Dev. Good afternoon, everyone. Firstly, I would like to give an update on the performance, the industry, and also run through the financials. Most of you are aware that we are in the business of manufacture of rubber chemicals, and we are in this business for more than 4 decades. Rubber chemicals as a compound, as a product, is dependent on rubber usage. So by thumb rule, rubber chemicals constitute about 3.5 to 4% of the total rubber consumption. Rubber consumption we mean here it includes natural and synthetic. But the rubber chemicals forms a very critical component in the application of rubber products. NOCIL produces more than 20 products, thus enabling us to serve as a one-stop shop for customers. Practically, it services the entire product slate, maybe one or two may be left out. By having a stretch of 20 products, we are itself managing the risk management issue, not dependent on one or two products for revenues. The rubber chemicals goes into both tire as well as non-tire industry. Tire industry by structure consumes 60 to 65% of rubber consumption. So as a result, the rubber chemicals too have the same customer profile, more than 60 to 65%. Insofar as the non-tire industry applications are concerned, there are not many things: cycle tires, cycle tubes, molded extruded components, auto components, latex, footwear, conveyor belts, etc. And there are about 8-9 industries constituting 30 to 35% of the business. The quality and the strength of the tire depends on a lot on the chemicals used in the process to convert the rubber into tire. Typically, for an international customer, they take 18 to 24 months to approve any product of rubber chemicals produced by a manufacturer. In that sense, we, being an existing player with more than 4 decades experience, we have a competitive edge, as we have multi-locations and wide product range. During the last 1 year or more recently, the last few months, a lot of capex have been announced by both global as well as domestic tire companies. Most of these companies are our existing customers and have tested our products, and we enjoy their confidence. We believe that our expansions in in the field of rubber chemicals will benefit them, and we are in a position to serve them as well. The last decade, we have seen a lot of, or more than 2 decades, I would say, the rubber chemicals have seen a shift from the Western world to the Southeast Asia and China. So a lot of automobiles, tire industry have set up plants in around Southeast Asia, China, and India in particular. As a result, rubber chemicals too follow the similar trend. The capacities set up by the Chinese manufacturers have seen some development or some seen trend where the environmental issues at their end has not been up to the mark, and that's we witnessed during the year because of the corrections undertaken by the Chinese government. Due to acute competition with China, a lot of exits have also happened in the last 5 years. Some more consolidation of smaller players cannot be ruled out. Insofar as the financials are of the company, these are the first year of Ind AS financials, so there has been a recasting of the financial statements when compared with IGAP. The net revenue for the operations for the year financial 18 is 968 crores, a growth of 30% as compared to 742 crores in the financial year 16-17. Growth in revenue is attributed to a combination of volume mix as well as the price earnings, better realizations, and also a better product mix. Value addition for the year financial year 17-18 is about 527 crores, a growth of 37.5%. I think it's stated in the investor presentation, the value addition is calculated as revenue minus cost of materials consumed minus cost of traded goods as well as stock change. The operating EBITDA for the year stood at 263 crores as compared to 158 crores for the financial year 16-17, a growth of 65% plus. The EBITDA margin stands today as a result of 27% plus. This improvement is on the back of better efficiency, better product mix, better pricing for the product, as well as cost optimization benefits. The profit after tax for the year stood at 169 crores as compared to 97 crores in financial year 16-17, a growth of 74% as compared to the previous year. The net profit margin for the financial year 17-18 is about 17.4% as against 13% in the previous year. The debt equity as of March 18 stands at 0 as the company has net cash surplus of 245 crores. With a strong balance sheet and cash generation, the company is well positioned to execute all the above mentioned capex of 425 crores. Insofar as the dividend to the shareholders, in commensurate with the growth in profits, we have been rewarding the shareholders. If you see in the last 4-5 years, from 6% dividend in financial year 13-14, now we have gone to 25%. We believe as and when we make good money, we will reward the shareholders as well. From a pure financial ratios, the return on capital employed is at 24.5% as compared to 16% last year. And return on equity is about 16.3 as against 10.7% last year. The Ind AS also involves some recasting of some few items, I think which has been given in the notes to the SEBI results, namely the fixed assets deemed cost adjustment as on 1st April 16, as well as investments at fair value. These are the two main adjustments which has gone through the Ind AS. So, with this, I would like to open the floor for question answers.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, in order to ensure that the management is able to address questions from all participants in this conference, please limit your questions to 1 per participant only. We'll take the first question from the line of Nisar Wakaria from Lucky Investment Managers. Please go ahead.
Yeah, congratulations, gentlemen, for a very good set of numbers. My question is twofold. The first part is that can you give an approximate indication of the growth that we have made in this quarter in terms of better product profile, higher pricing and volume? We need a small breakup. And also, Mr. Srinivasan, for the benefit of all participants, since you said that we are a very well diversified company, can you give the maximum dependence of revenue and profitability coming from a single profile of products? These are my questions.
Okay. Thanks, Nisar. First of all, in terms of the volume growth for the financial year 17-18, it's about 12.5%.
Okay.
In so far as the dependency on a product profile, I think we have given 4 groups in the investor presentation, namely antioxidants, accelerators, pre-vulcanized inhibitor and post-vulcanized inhibitor. In so far as pre- and post-vulcanized inhibitor, we are about roughly 10 to 13% of revenue. In so far as the antioxidants and accelerators are concerned, the remaining you can split it 50-50. So I repeat, if you are looking at 13% as the specialty or the number 3 and number 4, the number 1, number 2 will be about 42, 43 or 44, 45, something like that. A broad analysis I can say.
Okay. And sir, what is the incremental top line that we have generated from selling better value-added products? Volume growth you mentioned is 13%. Our growth is obviously much higher for the year. So can you give a small breakup of that as well?
Product mix, I don't wish to disclose here.
Okay.
I think that's keep it with the business interest purposes.
Sure. Fine.
As far as the volume growth, I've already announced it.
Sure. Thank you so much.
Thank you. The next question is from the line of Abhijit Dey from BNP Paribas. Please go ahead.
Yeah, good evening, sir.
Good evening.
Yeah, what was the volume growth for the fourth quarter, sir, on a YY basis?
More or less double digit. 12.5 for the year is more or less 10% thereabout.
Okay. And your first phase of, capital expenditure is scheduled to come by when?
I think Mr. Dev announced it quite well. The first part of the Navi Mumbai capex is expected in this quarter. In fact, pre-commissioning trials are already going on, but we don't want to announce it till such time the commercial production comes in. As far as the Dahej expansion is concerned, we have already announced in the investor presentation, it is coming in Q3 of 18-19.
Okay, and what is the kind of,
Sorry to interrupt, Mr. Dev. May we request that you return to the question queue?
Thank you.
Thank you. The next question is from the line of Sunil Katari from Unique Investment Consultancy. Please go ahead.
Thank you very much. Congratulations for very good numbers, sir. Sir, I have two questions. One is, what is our current capacity in terms of tonnage and what type of capacity utilization that which we are? Because we'll be adding new capacity, I think, by September and by year end. So for current year growth, in terms of volume, say, maybe 12-14%, will we be able to fulfill if there is a demand?
The current manufacturing capabilities is about 55,000 tons. We are operating at almost 100%.
Right. So if required by, say, 12-14% volume additional demand in current year?
I think the question has been addressed earlier in the sense that we are setting up new manufacturing capacities at Navi Mumbai and Dahej. If you once takes into account that, I think most of those demand issues will be sorted out.
Right. And so my second question is, how price is determined? Because our customer seems to be they are a big player. The tire industry is a dominant player. So it is decided cost plus or international price, or there is some long-term contract. How it is decided?
The price is a factor of competition, the international CF price, and plus duties and exchange rate. The contracts are on quarterly basis with tire industry, and there is nothing called monopoly or price dictate terminology in a competitive business.
Thank you very much.
Thank you. The next question is from the line of Jasdeep Walia from Infina Finance. Please go ahead.
Sir, thanks for taking my question. So your gross margins for the year are higher by 300 basis points. So what's the contribution of price increase to this increase in gross margins?
I think we announced it. I think it's a combination of product mix and the price realizations as compared to the volume growth. And on both raw materials as well as finished goods, we experienced that. Since the value addition is more than 50%, you are going to get a better realization or profit margins.
So, but this gain in gross margin, how much of it is driven by price increase alone on a like-to-like basis?
Gain in gross margin, it cannot be very identified specifically. We have to look at a combination of 20 products, different segments, international and domestic. So it's a weighted average of several factors. One cannot attribute one single item for growth in gross margin. As I said, it's a combination of 3-4 factors. One is the volume growth, the volume profile mix, the price realization improvement, the value addition over the cost increase. It's a combination of 3-4 items. And also the cost optimization, because when you're producing a larger volume base, your cost optimization does take place. Got it.
And so could you make some comments on the situation you see in China as of now? Are things stabilizing? Are capacities coming back, or what's the?
They have started coming back. I'm not saying that we are not saying that they are not coming back. They are coming back, but I think some more time we have to give them, because the real news from China, it's always a question mark. It will take some more time before we ascertain the real facts of China.
Got it. Thanks a lot, sir. That's all from myself.
Yeah.
Thank you. The next question is from the line of Anuj Jain from Value Quest Capital. Please go ahead.
Hello, sir. Thanks for the opportunity. Sir, can you help us with the percentage of revenues coming from the products which are under anti-dumping duty?
It's about 50-50.
So 50% of our revenues are coming from those products, right?
Yeah.
And secondly, can you help us how the raw material prices for us have moved in FY18 vis-a-vis FY17?
It's moved significantly because the crude prices also went up, the benzene prices went up. These are our inputs are basically benzene derivatives. So it has seen a growth of 20% on a lower scale, and it has gone up as high as 50%.
Okay. Thank you. Thanks a lot.
Thank you. The next question is from the line of Manan Patel from Equirus PMS. Please go ahead.
Sir, thank you for the opportunity and congratulations for a great set of results. Sir, my question is in continuation with the previous one. So, you said 50% of the products are under the anti-dumping duty regime. So, do you have any views on a continuation of anti-dumping duties, and if they are not continued, how will it affect our margins?
I think that has been already announced in the Dahej game changer slide in the investor presentation. The duties, current anti-dumping duties are in applicable till July 2019. Right. As a anti-dumping contribution to the gross margin or the EBITDA margin, it is constituting about 4%. I think that is evident in FY14-15 slide. So, if at all, if you are looking from a worst case scenario whether the anti-dumping duty is reduced or suspended or gets removed, you can see a worst case of 4%. But internationally, what we have seen, as and when the anti-dumping duty gets suspended, the CIF prices from the exporting country goes up, and that is what we have seen in our inputs as well. And when I'm looking at a larger volumes, this impact will be insignificant.
Understood, sir. Thanks a lot.
Thank you. The next question is from the line of Srinath Sridhar from ICICI Securities. Please go ahead.
Hello. Thanks for taking my question. Sir, as you said that 3.5% of the overall rubber production is your rubber chemicals. So that's a market size of about 10 lakh tons, right?
Maybe. Around 10 lakh you can say.
Okay. And so what will be the India market size out of that?
India market will be about 70,000.
70,000. So since we have about, so we can't take 55,000 as our actual capacity, right? Because it's intermediates and final products.
Yeah.
Okay, so we would enjoy a market share of at least 50% in India?
Maybe in the current circumstances, yes, more than 50%. Maybe 6 months ago I was saying about 45 thereabout. And it depends on product to product because we are looking at a global number. When I'm looking at a specific product to product, this number also goes up very significantly. It changes a wide range. In some product it may be as low as 10-20%, and some product it may be as high as 80% also.
Okay. And sir, who are the biggest suppliers apart from us globally?
In India or global?
India and global. In India,
I think in India, NOCIL is number one as far as domestic manufacturer are concerned. In India, there is a manufacturer called Lanxess India and PMC Rubber, who is a very, very small scale. There was a fourth company called Merchem, but he is closed for almost 2.5 years.
Okay, Lanxess. So Lanxess is a global company as well, right?
Yeah, it's a global company as well. As far as world over is concerned, in China, you have to look at China Sunshine.
Okay.
Sinochem, or Sinochem, what is called.
Okay.
Then Kumo Petrochemicals.
Okay.
Then Eastman.
Okay.
And Lanxess Worldwide.
Okay.
I think I've given you the 4-5 names. That's
right. And so in China, so these China Sunshine, Sinochem and Kumo might be producing at not their highest capacities, right, at the moment?
That's a question mark. We are, as it stands today, what the information is, they are not producing at 100%. They are operating at a little lower percent.
Yeah. So your margins look... Okay, sorry.
As we understand, it is about 50-55%.
Okay, 50-55%. So given that your margins are at all-time highs, what can we assume as a sustainable level?
Given the current conditions and the current outlook we do not see much of a challenge as far as in the immediate 6 months or thereabout. Thereafter, we have to see as how it unfolds out of China's correction post-environmental. And basically what's happening is there are no new major capacity announcements or expansions announced by competitions. And given that information, we believe we are in the right space to encash this opportunity. Let's hope for 2019 we'll see how it unpans, but 2018 we do not see much of a challenge.
Okay, sir. Thank you.
Thank you. The next question is on the line of Pawan Kumar from Unifi Capital. Please go ahead.
I just wanted to understand the proportion of exports in this year's sales. And number two, when we are saying 50% of our portfolio benefits from anti-dumping duty, it would be the domestic portfolio, right, obviously?
Yeah.
So what would be the proportion of exports that we have today in the revenues?
27%.
So effectively 35% is the proportion of revenues that is getting impacted by anti-dumping.
Yeah.
Okay, fine. And about the margins, what is your commentary, sir? 30%, it has crossed 30%. So EBITDA margins, what would you say will be the sustainable kind of levels?
I just answered to the previous questioner, so please don't ask me to repeat it.
Okay, fine. I'll come back.
Thank you. The next question is on the line of Nishit Jalan from Kotak Securities. Please go ahead.
Hi, sir. So my question is on the volume or revenue growth that you're expecting. If I look at, you are incurring a capex of about 425 crores, and at 2x asset turns means about a 850 crores top line on your base of about 1,000 crores. So when do you expect your plants to fully utilize? And basically, what kind of growth are you expecting from the domestic market in the next 2 to 3 years?
I think to answer it a little differently, this capacity will be set up by Mr. Dev announced by September 2019 or thereabout. And thereafter, once we set up, any chemical plant takes 3 years to stabilize and run at full capacity. Although it would be our endeavor to utilize the capacity much earlier, depending on the market conditions, market forces, as well as our optimization capabilities. So, a large part of this capex will be coming at Dahej. In our opinion, some of the Dahej setup, especially in the field of accelerators, we are already received inquiries. We are in the discussions with the customers. We believe that the utilization will be much faster than 3 years.
So basically, in 4-5 years' time, you would be like fully utilizing your plants from now on, which means about a double-digit kind of a volume CAGR.
Just repeat your question, please.
So you said 3 years, so which means from now, if I look at from plant commissioning and then 3 years' time, so in 4 to 5 years, you would look to utilize your plant, the new capacity.
That's on the conservative side.
Oh, so that means basically a healthy double-digit kind of a volume growth you are expecting.
Yeah.
So will it be driven by market growth, or you are expecting some further market share gains over here?
We are going to eat into some market share because in some of the products where there are no domestic manufacturers, so we are going to set up that, and the imports are going to today feeding the customers' demand. We believe once we start to come into the main production game, I think some share will come to us naturally because any customer would like to have more than one source.
Okay. So my final question, if you mentioned the domestic market, 50% of your products benefit from anti-dumping duty. Do you have any data in terms
50% of turnover, not products.
Turnover. Correct, sorry.
We only benefit out of 6 out of 20 products.
Sir, any timeline as to when is the revision of anti-dumping duty due on those 6 products?
July 2019.
And there will not be an interim review till July 19?
No. Till July 19, the duty is in force. Thereafter, we will make an application depending on how the case comes out as per the anti-dumping rules and directorate. So, we'll take a call at that point of time. The principal point here is, I think in a rollover of anti-dumping duty, the first question which is generally asked is a likelihood of an injury.
Correct.
We have announced in the past that in a market where 70% of their capacity, world capacity, is manufactured in one country, but their domestic consumption is only 33 or 35%, it is automatically creating an export surplus, which is called as likelihood of an injury. So under that ground, we believe we have a good case. It remains to be seen on other parameters whether we fit into the particular issues with anti-dumping directorate.
Okay. And so what kind of anti-dumping duties are on those, and as in the percentage of anti-dumping duties on those 6 products?
I think you look at the anti-dumping directorate site, you will have 6 products, 20, I would say 7 suppliers, about 40 odd matrices there. I think run through that and probably you'll get an idea.
Okay. Thanks a lot. Bye-bye.
Thank you. The next question is on the line of Alok Ranjan from L&T Mutual Fund. Please go ahead.
Hi. Thank you, sir, for taking my question. Sir, I would like to understand more on the China side. So before this environmental compliance started to come, prior to that, the capacity that was there in China and now the capacity that they have, how much delta is there? And when you say that, now you are seeing some capacity expansion, maybe some might be coming. So what is the percentage that we can see right now?
Each of the competitors in their announcements have admitted that some of their operating units, plants have closed down for environmental reasons for 15 days, 1 month, whatever it is. They have publicly announced it, admitted to it. Now, we cannot arrive at the actual gap which suffered. But what we did, one can gather is that there was some supply chain disruption between September to December or thereabout. Thereafter, the situation has started slightly improving. But the surplus which was there in the marketplace, that has to a large extent gone. It's more or less equilibrium.
Okay, fine. And my second question is related to the raw material pricing. So we have witnessed that the crude prices, have started to show uptrend. So what is the sensitivity of our raw material, final, the cost of goods compared to the $1 increase in the crude oil price?
See, again, I think crude is one part. We have naphtha, another intermediate in between, and then the next comes benzene, and from there our inputs come in. We are procuring amines and solvents. Now, difficult to arrive at a standard equation because there is always a time lag depending on the regional imbalance, supply-demand situation. Insofar as the costing is concerned, I think what we do is we generally are covered for 1 quarter as a policy, or you can say if you see the inventory schedule, whatever we have, generally it covers for 1 quarter production or 1 quarter sales volumes. So looking into that, at least if there is a sudden spurt in cost increases, at least for 1 quarter we are not affected. What remains to be seen in the second quarter, whether we are able to pass on or whether the competition is able to pass on. By and large, what we have seen in the last 3.5, 4 years is we are moving in tandem with how the competition is behaving, and we have seen the cost increases as well as cost decreases. On both occasions, we are able to manage to maintain our EBITDA margins. If not
right. Thank you, sir. That's all from my side.
Thank you. The next question is from the line of Rahul Veera from Elara Capital. Please go ahead.
Sir, a small question. I think currently the MOR, Qtr4 MOR, is facing some resistance because of substitution from TBBS. So what kind of revenues we generate from Qtr4 MOR?
It's about 1 minute. MOR and TBBS can be seen together in totality. But MOR as a product, we don't have such a big issue to be worried about. It not even forms 7% or 6% of my revenue.
Okay. And sir, so are we expanding into TBBS?
Still it has demand. Still it has demand.
Okay. So are we moving on the TBBS side, sir?
Yes.
Okay. So capacity expansion will include TBBS now?
Yeah.
Okay. And in terms of, sir, EBITDA margins, as you mentioned earlier, so for 6 months we have the visibility, but I mean, in terms of the competitive pressure and the input cost, where do you see like 3 or 5 year EBITDA margins to be? Where would we as a company would like to stabilize the margins irrespective of the input cost or the competition?
You need to move in tandem with the way market forces function. So I don't think so it is right on any company or anyone's part to predict about future margins, though they have an internal target to earn some percentage, but we would not like to commit here. We have internal targets because there are so many external factors which can alter the whole targets. And like all of us cannot predict what is the oil price in which direction it goes. Same way in a business, to predict an EBITDA margin is very difficult. But yes, given the outlook, the way things are going, in this year, the coming 6 months or 9 months, we do not see much of a challenge. We are quite confident, reasonably confident we can maintain it unless some sudden external factors in China or other competition can come in where it can cause a complete disruption. That's a different issue altogether. The way things are, given the current parameters, we do not see much of a challenge for the current year at least, or current 6-9 months.
Sure. So, sir, and last question, sir, whenever there is a new plant that has been commissioned, there will be some margin erosion, right, sir, for at least 1.5 years. So I believe to maintain these kind of margins at 27 to 30% seems a little bit of a challenge, isn't it, sir?
I mean, it is on the basic assumption premise that there are two issues. One is a new technology. It has some stability-related problems. That's the reason why we are not banking on first-year capacity utilization. We are looking at a 3-year horizon for utilizing 100%.
Right.
Second, a new establishment cost, but fortunately we already have the Dahej site already in place. So we do not, and it's a brownfield sort of thing. So far as a new site is concerned or a new green site, you can expect some additional establishment expenses, in this case, it's not there. The challenge here is to optimize the plant at the earliest and to ensure that offload the market or the additional capacity in the market at the earliest.
Sure. So, in this new capex is going to be within the top 6 products that we have, or it's going to be like from 7 to 14 products? To 7 to 20 products?
It includes all the 20 products. It may include some of the 20 products. I don't wish to reveal all the names now.
Okay. And sir, you mentioned that between accelerators and antioxidants, your margin profile is largely similar. Is that correct?
Yeah.
So then how does product mix change the help us in getting additional EBITDA margin?
Accelerator as a group, antioxidant as a group, within the group there are about 10 products each. So each product behave depending on the production cycle, demand cycle, supply cycle, as well as the specific raw material cycle. So if there is a sudden spurt in one of the inputs, it has to lead an improvement in margins automatically. If the competition is also behaving, or competitor also is increasing the prices in tandem with the way the cost increases are happening. So if you recollect, some time back I had said 20% is the minimum raw material price increase. Some cases it has gone up to 50%. So if that is the range, then even on the margins also you can have such wide ranges.
Right. Fair point, sir. I'll come back
within the group. I'm not talking about overall group.
Sure. Fair point, sir. Thank you so much, sir. I'll come back in the queue, sir.
Thank you. The next question is from the line of Augusta Dave from CEO Capital. Please go ahead.
Thank you for the opportunity, sir. You actually partially answered the question already. The new capacity, sir, will the product mix be significantly different? You said you are adding all 20 products.
I am saying it includes some of the 20 products. I never said all 20 products. I will clarify some of the 20 products.
Okay. But so product mix will change dramatically, sir? When the new capacity...
No, not really. It includes accelerators as well as antioxidants and some specialty as well.
And sir, with at current prices, assuming constant prices, you expect similar ROEs? I mean, my question is more to do with asset price inflation. Will the capex result in slightly lower asset turnovers?
Will the capex result in?
Slightly lower asset turnovers than your own plants?
No, not really. Not that we can foresee right now. We still maintain 2:1.
Okay, so overall, the product economics will be exactly the same when the entire thing is all done.
Yeah, 2:1 is, we are quite confident of maintaining that.
Perfect, sir. Thank you very much, sir. Good luck.
Thank you. The next question is from the line of Nav Bharadwaj from Anand Rathi. Please go ahead.
Yeah. Good evening, sir. Congratulations on the great set of numbers. While everything appears to be really green, only one number appears to be red. That is, the shareholding pattern shows a 1% decrease in the promoter shareholding. Any clarity as to why is the promoter decreasing his shareholding?
No, I think it has been announced in the declaration or disclosure to the stock exchange. Naveen were holding some holdings in NOCIL about 2%, and 1% they have sold in the marketplace, and that disclosure has already come in the market.
All right. Thank you so much.
Thank you. The next question is from the line of Jigar Jani from Edelweiss. Please go ahead.
Yeah, hi. Thank you for taking my question. Just wanted to know, as per our new CAPEX plans, how much of these products are the 6 products on which we have anti-dumping? I mean, in terms of amount, if that could be given, that would be helpful.
I said, I think some time back, let us keep it confidential at this point of time.
Okay, sir. And there is some restatement of our fixed assets upwards. So is that in line with Ind AS?
Yeah, that's right. I think I prefaced the Ind AS issue, and then especially there are 2 issues. One is about 140 odd crores investments at fair value, and another 180 crores fixed assets at fair value, which allowed as per Ind AS as on 1st April 16, and that's the reason why the asset has been inflated.
Right. And sir, I think you answered this earlier, but our mix will remain similar to what it is right now in terms of antioxidant accelerators and PN post inhibitors after the CAPEX, all 3 CAPEX phases, right?
Insofar as pre-vulcanized inhibitors, we are not expanding at the moment. So to that extent, it as a percentage, it will go down.
Pre-vulcanization?
Yeah. The rest everything will...
Okay. Thank you very much. Thanks.
Thank you. The next question is from the line of Ankur Jain, an individual investor. Please go ahead.
Hi, thank you, sir, for taking my question. This is with regards to the depreciation figure, which has seen a slight increase. So, you have answered in a couple of questions earlier that the fixed assets, there has been a reinstatement and the asset prices are inflated. So I just wanted to know that going forward, the depreciation figure of 11 crores that we see this quarter, is it going to be the normal depreciation figure for the current for the assets which we have right now?
I think what we have to see is the 17-18 annual depreciation of 20 odd crores, 21 crores thereabout. Okay. You can expect some additional depreciation this year on account of the 170 crores capitalization. Maybe about that will come in. So overall, the number may go up by 25, maybe at the end of the year, maybe go to 25, 27 thereabout, depending on the month in which we capitalize.
Okay, but for the existing assets, 21 to 22 crores is the depreciation figure that will...
Maybe you can take around 20.
Okay. Thanks a lot. That's it.
Thank you. The next question is from the line of Anand Bhavnani from Samiksha Capital. Please go ahead.
Congratulations for the wonderful set of numbers, and thank you for the opportunity. Sir, when I was looking at the overall anti-dumping duty benefits and the products that we have anti-dumping duty benefits for, I saw that when the rupee was at around 53.50 when we got the anti-dumping duty benefit, and it's around 67 now. So it's likely that a lot of our margin expansion happened because the rupee has depreciated. So do you see that anti-dumping duties would be revised lower when next year they come up for renewal because of this rupee depreciation?
No. I don't think so that would be. Generally, what they do is they compare the CI price at which he is exporting, the competition is exporting, and the fair, so-called the fair reasonable CI price, what is supposed to be counted in their local market. And if the delta is, whatever the delta is, and if they assume that delta is X dollars will be levied, exchange rate is a conversion because that is impacting at every trade transaction. It has got nothing to do what is the actual benefit. Because now, when rupee has gone from 53 to 67, it cuts both ways. Even by domestic input pricing also it goes up.
Okay.
You understood my point? So that means I'm going to pay 67 rupees exchange rate. The same benefit I will get it on finished goods price. You cannot have a different exchange rate yardstick.
Okay.
And extent of dumping also depend on the dumping margin, injury margin as per the dumping rules.
Okay. Sir, your analysis...
sorry to interrupt, Mr. Bhavnani. Sir, may we request that you return to the question queue? There are participants waiting for their turn.
Yeah.
Okay.
Thank you. The next question is on the line of Dhiral Shah from Asasi Mehta. Please go ahead.
Yeah, good afternoon, sir. Congratulations for the good set of numbers. So my question is regarding, so your value addition, contribution to the overall revenue has now reached 54%. So let's say within 2 years, next 2 years, how much do you feel it can contribute more?
Now, I think we are giving you a guidance for 6 to 9 months. Beyond that, I think it's too premature for us to give a guidance on that. So please.
And sir, how high are the margins in value addition as compared to the plain vanilla business?
Some margin improvement will always be there in the specialty chemicals, but we don't wish to disclose that.
Okay, and sir, currently your capacity is around 55,000 metric tons. So
correct.
How much incremental capacity you are adding in next 2 years?
I think we have already announced a 2:1 asset turnover ratio. That's implied answer to you.
Okay. Thank you, sir. That's it from my side.
Thank you. The next question is on the line of Shashank Kanodia from ICICI Securities. Please go ahead.
Yes, sir. Thanks for an elaborate call. So just one small clarification. We mentioned that margins at the current level will be sustained for next 6 to 9 months. So are we talking about the quarter exit run rate of 30% or the full year run rate of 27-28%?
You're very specific, huh? I think we have to look at an average of 17-18, and that is what we are looking at, maintaining a trend of 17-18.
Okay. Fine, sir. Thank you so much. That's it.
Thank you. The next question is on the line of Gelada from Perfect Research. Please go ahead.
Thank you for the opportunity, sir. My first question would be, how are major competitors in India and globally, and how are we better placed vis-a-vis our competitors, and what is an addressable size of opportunity for us?
Mr. Lada. So, we are not able to hear you clearly.
Hello? Can you hear me now?
Yeah.
Better, thank you.
So, thank you, sir. So, how are we better placed vis-a-vis our competitors, and what is the addressable size of opportunity for us?
I think two things. In terms of competition, I think most of the competition are announcing a similar results in terms of their performance. You can refer China Sunshine's results. It speaks for itself. So more or less the EBITDA margin range, etc. here and there have been more or less similar to NOCIL. In so far as expansion is concerned, we have not seen any major announcement by our competition in terms of expansion plans. So accordingly, we have already announced because we have funds and we have the capability to execute, and we believe there is an opportunity which we should encash. So that's the reason we announced all this expansion in this period March 17 to January 18.
The second question will be, could you throw some light on your ambition over 5-10 years going forward, or where do you see yourself in the next 5-10 years?
I think we have opportunities coming in the way, and we would like to encash, but we don't want to comment in terms of numbers or sizes or turnover, etc. That we would like to keep it confidential at this point of time for business reasons.
So I don't need the numbers, but throw some lights on our strategy going forward.
My dear friend, we are at 4% market share or 4.5-5% market share. We would like to increase, double that at least minimum. Something more than that, we'll see as and when the opportunity arises. Let us see how the market unfolds over the next 3 years. Thereafter, we can take a call. And as and when any announcements are there, we are going to announce to the public domain.
Okay. And the last question will be from my side is, could you throw more light on partnership initiative on new products being developed by you or with customers?
We have some understanding with the customers, but there are these are all confidential matters. We don't like to keep it bring it in the public domain.
Okay, sir. Thank you so much, sir.
Thank you. Ladies and gentlemen, due to time constraint, that That was the last question. I now hand the conference over to the management for the closing comments.
Dear all, we take this opportunity to thank everyone for joining the call. We hope that we have been able to address most of your queries. For any further information, kindly get in touch with us or SGA advisors, our investor relation advisors. Thank you once again. All the best to everyone.